Hello YouTubers, my name is Ankit and welcome to Simply Investing. The market has been red and it seems like the stocks that were making you money in the recent bull runs are now dropping. This volatility in market exposes you to both opportunities and risks of investing. It's very important that you carefully skim through your watch list and make the right stock picks. You may have come across this meme that recommends you to buy the dip. While that's a great strategy, you don't want to be digging your own investment grave by making a wrong stock pick. So today, I'll be sharing my favorite dividend stocks. A lot of them have been pretty stable. They have either gone up or just dropped a small amount when compared to the rest of the stock market. The stability that these stocks offer, along with the opportunity to earn passive income, is something that cannot be taken lightly. And some even offer opportunities for huge growth. Now, these are not just any random recommendations. I personally own or have owned many of these stocks. And if you're someone new, please check out this video as I share my passive income for my first year of investing. You may be quite surprised as to how much you can earn by just holding on to a stock. Even for aggressive investors, I would recommend that you allocate at least a small portion of your portfolio. It can be as little as 10%. But before we move forward, if you like the content of this channel, make sure to hit subscribe, click the like button, and hit the notification bell to be notified of my latest content. This would really motivate me to even create some of this content in the near future for you guys. Also, the Ultimate Financial Tracker that I mentioned in one of my previous videos is on sale now. So please use the code SimplyYouTube to get an extra discount. Now that we've covered that, it's time. It's time to share my top 30 dividend stock picks. So let's get started. So first on the list, we have the Canadian banks, and to start off, we have Scotiabank. This is something I've held on to for pretty much the last 6 to 7 months, and it has a strong dividend yield of 4.7%. Recently, it's been doing good. Over the last 6 months, it's made an excellent recovery, and even if you look at the last year, so prior to the pandemic, we can see that the stock is pretty much at the same level. Market cap is great, and these banks have actually recently reported excellent earnings. And so I do think the Bank of Nova Scotia is actually one of my top picks when it comes to the Canadian banks. Second on the list is TD. It has a dividend yield of 4%, a slightly bigger bank with more operations in the US. Again, the banks, as I said, they made such an excellent recovery. It's up almost 15% since the pre-pandemic level. And if you look at the 5-year chart and we go right before the pandemic, you can see it's made an excellent recovery of almost 4%. Continuing with the banks, we have the Canadian Imperial Bank of Commerce, or CIBC, 4.87% yield. Again, similar recovery, and maybe even slightly higher than the other banks, but it is pretty expensive with the stock price being at $119. Moving forward, we have Bank of Montreal. This is a stock that I actually owned previously. I bought around the $66 mark. I wish I'd owned it because that's a great recovery of 65%. However, the profits from that stock were reinvested into other stocks, therefore growing my portfolio. Again, Bank of Montreal, strong dividend yield of 3.95%. So as you can see, the Canadian banks are very stable, and I would recommend that you add at least one of these into your portfolio. In fact, if you're adding any bank from anywhere around the world, Canadian banks are one of the safest bets. So moving on with telecommunication companies, there's 3 big ones in Canada: Rogers, Bell, and TELUS, and Bell and TELUS are on my list. Bell and TELUS, I really like them because of their strong, attractive dividend yield of almost 6%, and TELUS is at 4.77%. Let me just go back to Bell. You can see that with Bell in the last year, it's still down from the pre-pandemic level, but I see it as an opportunity for growth. Until it grows, you're getting that 6.31% if you were to buy the stock. TELUS, I find, is probably the better telecommunication company, just because it dives into many different sectors, including TELUS Health. As someone who works in the healthcare field, I know that TELUS is being widely used by the healthcare professionals. And with an attractive yield of 4.77%, I don't think you should be missing out on the stock, to be honest. And next is the utility sector. And when it comes to utilities, I cannot see anyone missing out on Enbridge. That's probably the first utility company that you should have in your portfolio. It's definitely the one with the highest dividend yield that I know of, and it's pretty stable. Now, the good thing about utilities companies is that they have long-term contracts of 5 years or maybe even 10 years as well. And so to get this attractive yield of 8% is amazing. And Enbridge actually makes the largest holding in my portfolio. So if you look at this year to date, you can see year to date it's had a nice trend of almost 8% upwards. And right before the pre-pandemic level, I know it was at around $56 mark, which would be a great target to sell. I think I already have my sell order targeted at $56. However, I would not be selling all of my stocks because I do not want to miss out on this dividend yield. Then we also have Emera. Again, this is another utility company. Now, this one is probably presenting you with the best opportunity to buy. And that's because it's had a nice little dip. And most of this dip was caused because of the recent increases in the bond yields. And so I think this is an attractive opportunity to buy. If this were to drop below $50, I would jump on this without any questions asked. Same goes with Fortis. Fortis has an extremely strong dividend payout history. I think they're one of the top dividend aristocrats, and they've been increasing their dividend year over year. And I know it's sitting at 4%, which compared to Enbridge and Emera might seem a bit lower, but it's so consistent. If you look at its 1-year history, it's hardly moved, but it's had a good enough dip to justify a buy. And if you take a look at its 5-year chart, you can see that nice upward trend. Again, because of the pandemic, it did start to go down, but I have no doubts it'll be going back up. And Canadian Utilities, again, great dividend yield at 5.78%, and it is also a dividend aristocrat. Over the last year, you can see it's not done as well as maybe its other counterparts, but this is a company that I know for sure won't cut down its dividends. So when it comes to the dividend payout history, I think this is the strongest of them all. And next up, we have REITs. Again, REITs are probably one of the most underperforming sectors in the market, especially during this pandemic, but I see that as an opportunity for growth. And REITs tend to bring amazing dividend yields. So I'm going to rush through a couple of these. So RioCan, currently at $19, offering 5% dividend yield. Obviously, you would have heard about the dividend cut that it had recently, but nonetheless, 5% is damn attractive. Smart Centers, again, this is probably the closest competitor of RioCan. 7% is doing great. Again, opportunity for growth. It was at 30 pre-pandemic levels, so another maybe about 12% opportunity for growth. And next we have Northwest Health REIT. This is something that I bought at the same time as RioCan. And this is a REIT that focuses on medical properties and it leases this out to other healthcare professionals or healthcare management companies that can use it for medical spaces. This REIT has not really gone down significantly. So if you see over the 5 years, nice positive trend. It did have a dip right after the pandemic hit, but it's made a strong recovery and I think it's going to be pretty stable. Next up, we have Chartwell Retirement Residences. Again, 5.5%. Over the year, it's made a great recovery and it has a lot of potential to go back up. As you can see over the last 5 years, it hasn't changed much. So it really tells me that, around $14, $15 mark is a great place to be. And currently the stock is not reached there yet. It's sitting at $11.11, which offers me about a 20% room for growth. And while it's growing, obviously I have a chance to get that dividend of 5.5%. Nexus Health REIT is an amazing REIT. You might see the sharp drop, but that's because it had its shares split. And so now each share is valued at $8. Really, it hasn't had that much movement in its share price, but it is offering a great yield of 7.88%. All right, so I want to keep this video nice and short, but at the same time, I want to make sure I cover all 30 stocks. So what I'll be doing is I'll be releasing a part 2 to this video, which will be released very soon. So please make sure to look out for that video. Until then, please click like, hit the subscribe button, and share this video amongst your friends and family. I'll see you in part 2.